Hey everyone, Lewis here. Welcome back to the channel where we talk about finance, real estate, and investing. In today's video, I'm going to give you a little bit of insight as to where mortgage rates are, where they're headed, and how you can track them on a daily basis if you choose to. So let's jump right into it here. So up on the screen, I have the Freddie Mac website. For those of you who don't know, Freddie Mac is a government-sponsored entity, and they are one of the largest purchasers of mortgage-backed securities on the secondary mortgage market. Right here, you can see they list the mortgage rates. Now, this is an average, so they break it down into a few different categories. Right here, we have the 30-year fixed-rate mortgage. Right here, we have the 15-year fixed-rate mortgage. And right here, we have a 5/1-year adjustable rate mortgage, or a 5/1 ARM, as they call it. That's fixed for a 5-year period, and then it can adjust 1 year on its anniversary thereafter. So now, per the average, this is a U.S. weekly average as of January 14th, 2021. 30-year fixed is sitting at 2.79%. But that is associated with 0.7% in fees and points. So let me explain what that means. And I tell a lot of people that it's not just the rate that you can secure, but it's also the fee structure that comes along with that rate. So anyway, the way that works, 0.7% in points is the cost in which it takes to secure that rate. So for example, let's say you have a $300,000 loan, and you're paying 0.7% in points. That'd be $2,100 cost to secure that rate, and then you would factor your additional closing costs on top of that. So let's say you have processing, underwriting, and third-party title fees. Those probably will run you somewhere around $2,500. So in other words, between points and fees, that 2.79% rate might cost you $4,600 added to your loan balance in order to secure that. Now, there's lots of different mortgage lenders and brokers out there, so you do have the ability to shop. I typically tend to lean towards a structure where you pay less in fees so that it's a shorter recoup period, but it's mostly a personal preference. So it just depends on where you want to go. But anyway, that's where we are in the 30-year, sitting on average at about 2.79%, and then the 15 years at about 2.23. So 2.25 to 2.375. And right about the same fee structure, 0.7% in fees and points. So one thing I want to point out is here's a 1-year chart showing where these rates have been over the last 1-year period. You can see that, so the 30-year fixed rate is in blue, the 15-year is in green, and then the 5-year adjustable rate mortgage is in orange. And you can see that the 30-year, about a year ago, was hovering at around 3.5%. We've been on a pretty substantial downward trend ever since. Right here, up until recently, we've seen some volatility where they've spiked up a hair, but still historically they are very, very low. We're sitting at about 2.79% right now. So anyway, that's where rates are right now. We have seen some volatility over the last couple of weeks where the rates have spiked a hair, and you can see that indicated in the chart. What I want to show you is what these rates track pretty closely, and that's what we call the 10-year Treasury Yield. So if we pop over to CNBC, this is the CNBC homepage, and we click on bonds, the first thing that pops up here in this upper left-hand corner is the 10-year Treasury Yield. And if you click on that, we can get a look on where the yield has been over the last 1-year period as well. So this is the 10-year Treasury Yield. It's a 1-year time frame. Let's go down to the chart and take a look. So if you go back to March and February of 2020, when we started to see lockdowns and a lot of economic impact due to the virus, you can see where the yields were near 1.65%, almost 1.75%. We saw a massive reduction here into March of 2020, where the yield dropped substantially, and it stayed relatively low for several months up until about August, hitting a low at about 0.5%. Since August until today, we've actually seen a pretty nice gradual upward trend, as you can see here. And then more recently, you can see a spike in the yield. So it's still, if you back this chart out, you can see that these yields are still extremely low from where they were, even a couple years ago, sitting at just over 3%. We're still at hovering around 1%, as you can see here on the chart. So anyway, the reason I'm pointing out the 10-year Treasury yield is because typically mortgage rates follow the yield in lockstep fashion. So in other words, if the 10-year Treasury yield goes down, you'll see mortgage rates tend to come down with it. If the 10-year Treasury yield goes up, mortgage rates tend to increase. What's interesting about what happened when the market corrected in March of 2020 is there was a small divergence. And so I found this interesting chart here. This is from Mortgage News Daily, and this shows where rates were over the last year as well as where the 10-year Treasury yield was. So if you look at this chart, you can see that if you go back to 2018, the green line represents where mortgage rates are, and the blue line represents where the Treasury yield is. And you can see that rates basically follow the yield in lockstep fashion. I mean, almost identical movements here. Now, when you get to Q2 of 2020, which is right around March, you can see a massive divergence where mortgage rates actually spiked and the 10-year Treasury yield went down substantially. And I think what ultimately happened is there was a liquidity problem, and there wasn't an appetite for these mortgages on the secondary mortgage market, and everything froze up until the Federal Reserve stepped in to buy these mortgage-backed securities. So you can see that mortgage rates spiked quite a bit here in the second quarter of 2020, but then they gradually fell. So it says mortgage rates couldn't keep up in 2020. What they're referring to is it couldn't keep up with the 10-year Treasury yield, as in there was that divergence, and then the mortgage rates fell and kind of followed the yield all the way back down to where they are today, where that yield and the mortgage rates actually reunited, and now it looks as though they're starting to follow each other in lockstep fashion again. But what's interesting is more recently, over the last couple weeks, we've seen quite a bit of volatility in that 10-year Treasury yield, and we've seen that upward trend. So what's going to be interesting moving forward is if we continue to follow that upward trend, if the Fed is going to step in to buy additional mortgage-backed securities and peg that yield curve and ultimately try to hold those interest rates down a little bit lower. Personally, I think they will moving forward out of the first quarter of this year. But in the short term, I think we might still see some volatility in the markets. So that'll be interesting to kind of see how that pans out. As a reminder, mortgage rates right now are still at all-time record lows, as indicated by the Freddie Mac website here. I mean, we're still under 3% with 30-year fixed rate debt. We're in the low 2s on a 15-year fixed rate. On the 5-year adjustable, we're a little higher. In this environment, I don't really know any reason why you wouldn't want to go with something fixed. If you found that information useful, if you have any questions, put them down below, and I'll link to the Freddie Mac website and CNBC here in the show notes. Thank you so much for watching. You have a great day.